Welcome back to our RSI recorded webcast series. These recordings have been developed in support of the articles, blog posts, podcast episodes that you can find on restac.net in our resource center. There you can also find relevant restaurant industry trends and topics such as cash management, budgeting, labor management, hospitality compliance, and more. If you have any questions during the presentation, tweet them to us at RSI Operations, #MitigateTheWage. As all of you in the restaurant industry know, lately minimum wage increases have been taking control of all of the headlines. It's certainly a hot topic where everyone has a strong opinion to voice and they're trying to make their case. Some states have already experienced the first phase of increases while others are still in talks, but it goes without saying that everyone is aware that changes are coming. So accordingly, we've been spending this month using the decision-making triangle to focus on different ways to manage the impact that a minimum wage hike will have on all aspects of your restaurant. As always, feel free to check out our resource center where you'll find the article, 3 blog posts, and recent podcast episode on our best practices and strategies on the topic.
If you've registered for any of our previous webcasts, you will notice that today's presentation is going to be a little bit different. Within our most recent blogs and podcast episode, which you can find on restat.com, you can already find our tips and best practices for managing a minimum wage increase. So today, we're actually going to look at some cold, hard numbers and apply them to 2 different scenarios of management: adding a surcharge or increasing menu prices. To start us off, we'll take a look at steps to determine exactly how much a minimum wage increase will cost your business, and then we'll dive into the circumstances of trying to recoup your loot. Pro tip: run through your numbers and know exactly what type of deficit you have to cover before implementing any changes. In order to figure out how the minimum wage increase is going to affect your net profit, you've got to do some homework. Start with looking at your prior year history for both sales and net profit. In this example, you can see your year-to-date total sales for 2014 was $1.5 million, with your net profit hitting 6.67%. You will also want to look in detail of your hourly labor expense by job code and work center. Once you know the average wage per job code and the total number of hours worked last year, you can see what your operational labor dollars and percent were prior to the minimum wage hike. In this case, it was 23.26%. Next, you will want to look at the exact same picture with the new average wage plugged into each job code. Calculate the difference between last year and this year to see how much more you will be spending with the same sales and the same labor. For example, if you were to make no changes to what you're currently doing, what will the minimum wage increase cost you? Once you can see the dollar impact, deduct the number from the gross profit to find the net effect on your bottom line. Here you can see a loss of $50,076. Now, let's look at different ways you can recoup that cost.
Thanks, Kat. So let's add in a surcharge that we see fit and then run the numbers. We'll take 3% as an example. Calculate the additional revenue from the surcharge and add it to your prior year's sales categories. Then compare your new total sales from adding the surcharge with your previous sales to find the difference. With a 3% surcharge here, it's $45,000. Using the same labor model with the increased minimum wage for all job codes, you can then plug in the additional revenue and add it back on to your GPPC. Did this get you back to where you were last year? Are you still hitting your budgeted net profit? In this example, we came very close. Our profit with adding a 3% surcharge got us back to 6.05%, where it was previously 6.67% before the minimum wage. So here you can see if you were to do nothing, you would get 3.34%. By adding a 3% surcharge, you would get yourself to 6.05%.
Now, are you considering doing away with having a tip line on the bill, but adding a large enough surcharge to where the money would then go back to the staff in the form of wages to offset the minimum wage hike? For this scenario, let's assess a 21% surcharge since we'd be eliminating voluntary gratuities altogether. Your sales would then increase to $315,000. Now that you've determined the increase in revenue that the 21% surcharge would cause, you'll need to determine how much of that increase will go towards offsetting the wage increase, and then review how much is left over to distribute amongst the staff who no longer receives tips. Pro tip: have a system in place to track the distribution so that it's transparent and fair to everyone on payroll. In this scenario, 16% of the revenue from the service charge is needed to cover the wage increase, which, if you recall from earlier, came out to $49,924. That leaves 84% of the pool that can be put towards other earnings on checks as well as employee benefits. In this scenario, we put it toward employee wages. Now use the labor model with the increased minimum wage with the extra 84% from the surcharge and plug in the additional revenue back to your gross profit. Now, where did this get compared to last year? Again, in this example, we came very close. Our profit, with adding a 21% surcharge, got us to 6.19%, whereas previously at 6.67% before the minimum wage increased. Let's go over a quick summary of things you'll need to remember when adding a surcharge. Number 1, review your prior year sales history as well as net profits. 2, make sure to look at your hourly labor expense both by job code and work center for pre- and post-wage hike to find the deficit you'll need to cover. 3, plug in any additional surcharge numbers to see where they will get you in comparison to if you change nothing at all. And number 4, some folks are adding a surcharge and keeping the tips while others are looking to get rid of tips altogether and direct the higher surcharge back towards higher wages. Find the path that works best for your specific operation. And some additional notes to keep in mind. Be sure to consider the payroll taxes and workers' comp taxes that will increase since the payroll dollars will be higher overall. And make sure that your POS system is set up to calculate the sales tax on the bill after the surcharge has been added.
Extremely important that it goes on after.
Now let's take a quick look at another road people can take when working to mitigate a wage increase, which is elevating menu prices. So what do you need to consider when implementing price increases to items on the menu? First off, just like the surcharge scenario we went over, you will need to determine how much the wage increase is going to affect your business without changing anything that you're currently doing. In order to do this, you'll need to figure out how many more guests you would need to serve to make up for the $45,000. To do this, you would divide the loss by your guest check average to figure out how many more mouths you'll need to feed annually or daily to make up for the deficit. Since the additional guests are not guaranteed to walk through your door, it is critical to evaluate your PMIX. What are your top and bottom sellers in each master sales department? Does it make sense to significantly raise the price on items that you sell the most of, or will that create more harm than good?
In order to figure out what the impact would be, you would need to understand how much money you drive to the bottom line on each item. This can be done by costing out each plate and then menu engineering what you are selling to determine the contribution margin of each item. Once you realize the most popular and profitable dishes, as well as the ones that are big sellers with lesser margins, you can better identify where to make the price increases and/or menu adjustments. Guests don't care about your food costs, they care about the perceived value in what you are delivering to them. Be careful not to overprice items that can be found cheaper next door with the same quality and similar ingredients, i.e., raise the prices but only when appropriately done. Signature dishes that you are known for exclusively would often allow for a more aggressive increase due to supply and demand. The key here is, again, do your homework. Have a system in place that you can track the margins over time so that in 13 weeks you can determine if the plates are still selling and that your guest counts have not started to shrink.
We hope we've been able to shed some light on the different options you have when it comes to covering deficits caused by increasing minimum wages. Just remember, we're here to educate and assist you with our best practices, insider tips, and even the same tools that we offer to our clients. If you have any questions about what we do or find any of the tools or strategies from this presentation might be relevant to your own restaurant, please don't hesitate to reach out and request a demo.